I mean, my first multifamily purchase was a 32 unit in Indiana, and we paid a little over $1 million for it. I think we paid about 1.2 million at the time. You've got your disadvantages and advantages. I think when it comes to, that's a good question. I think, yeah, you could obviously do it individually. I think especially like the smaller the project, like if you're doing a 10 unit, it's going to be a lot easier to do like a solo project. Totally doable.
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today, we have a very special guest. His name is Shawn Dimartile. He is one of the owners of Takeoff Capital. And today, he is going to be teaching us how to buy your first apartment complex state by state. Welcome to the show. Shawn, how are you?
I'm doing so well. Thank you. Thanks for having me on the show. I really appreciate the opportunity.
Likewise, brother. Super excited because this is a question that we get frequently. So, for our viewers, Shawn, who don't know who you are, who is Shawn Dimartile, and then how did you get started in investing in apartment complexes?
Okay, so it really starts. I used to be an air traffic controller, and I got started just because years ago I was making good money. I wanted to invest, and a friend of mine told me about the Bigger Pockets podcast, and I kind of went down the weeds. This is about 5-6 years ago. Went through the weeds and read every book I could, every podcast I could, branched out, listened to more. And long story short, I really started to learn and realize the power of multifamily real estate apartments, and wanted to jump right into it. So kind of flash forward, I started a real estate meetup, started my own podcast, started doing everything I could, partnered up with about 6 other guys, and bought my very first apartment complex by liquidating my 401k and partnering with some people, which was a 32 unit out of state in Indiana. So that's kind of how I got started. I eventually got a mentor that has over 8,000 apartment units, and he really helped me get my first 2 syndications under my belt. And the company just started growing from there. Today, we own a little over 300 doors, a boutique hotel, and we're starting to develop over here in San Diego now as well. That's where I sit today, and still eat, sleep, and breathe multifamily real estate.
I love it. Now, I think you've taken an opposite approach to what I have. All of my apartment complexes are in Ventura County, and a lot of people are like, well, why would you buy in California? And then I have other friends that everything that they own out of state. My fear with investing out of state is that I don't really know the markets that well, and most of the resources that I have are here in Ventura County. So if somebody's considering buying their first apartment complex, should they invest out of state, in state? What are your thoughts on that?
That's a good question. I think that it comes down to a number of factors. I think first and foremost, money is always going to be a big thing. If you're like us and you live in California, it's much more expensive to get into multifamily investing, especially on the commercial end. So with that being said, the barrier to entry, I think, is tougher here in California. It's not that I would shy people away from investing here, but it really depends on your market and your individual situation. Investing out of state can provide the benefits of it simply being cheaper, so you can get into multifamily, get your feet wet, and start building a portfolio a little bit easier. I mean, my first multifamily purchase was a 32 unit in Indiana, and we paid a little over $1 million for it. I think we paid about 1.2 million at the time. So you've got your disadvantages and advantages. I think when it comes to like you said, your fear of just not knowing the market, you could do the best you can by being a data geek and looking at the data in great detail for individual markets and submarkets, which is what we did. And there's a lot of key performance indicators we looked for in a particular market. So I think that's really the best you could do. And then obviously flying there, getting a feel for it, understanding the neighborhood that you're thinking of investing in, all of that can kind of make you feel a lot better about investing out of state. But there's always, disadvantages that go along with that.
And what are some of the key performance indicators that you would look at when analyzing a market?
The top 3 that just kind of will help me eliminate a neighborhood right away or make me want to look into it deeper are the median household income, the school ratings, and the crime ratings, because that right there will tell you whether or not and those are kind of all related. So if it's a higher income neighborhood, generally you're going to have better schools and lower crime. But I like to look at those because that gives me the best snapshot, very quickly, of whether or not it's a C minus D class neighborhood, or am I in a B class neighborhood? So, for example, that property in Indiana that we bought, that was in a neighborhood that had really low crime, 10 out of 10 schools. The median household income was above $70,000, which in Indiana is pretty dang good. So it really had all of the metrics like from the get-go. And then, when we started to look deeper and we looked at income growth, job growth, things like that to determine, okay, is this going to remain a good neighborhood? Is this going to continue bringing in new good tenants? We start to look a little bit deeper, and the neighborhood that I'm talking about, Indiana, is Greenwood, Indiana, which is just south of Indianapolis, like 15 minutes. So we really like that market, and from there, it was just a matter of finding a good property, and we found basically the ugliest property in the nicest neighborhood we could find, which is kind of an old mantra of real estate. So we ended up doing really, really well. We actually tripled our investment in just a little over 2 years when we sold it.
I love it. Congratulations on that. That's exciting. Do you look for like minimum? Do you ever look? I know other people talk about population, like a minimum population size, and then they also talk about like population growth at all. Do you look at those at all?
So I don't really have a minimum population number per se. Like at minimum, I just want to be next to a major city that's still growing and isn't dying. So for example, Indianapolis has all kinds of great metrics, great job growth. It's got in-migration still. It's still a place that people can afford to live. Now, I'm not as interested in investing in rural markets. So, tertiary markets that have, populations, I would just ballparking here like below 300,000. I'm not as interested in. And largely that has to do with the fact that a lot of times those markets tend to have just like one or two main jobs available in the market. It might be all Walmart, or it might be all a university. I'm not really interested in those kind of markets, but next to major cities that have a population north of 700,000, I would say is probably where we'd like to stay.
I love it. And then what tools would you say are important when selecting the right market? Like certain websites, certain calculators? What tools would somebody need to have or would help in that research process?
So I'll give off like three, just kind of in order of how expensive they are. CoStar is always going to be number one. And if your listeners haven't heard of CoStar, that's basically the number one data source, the world's largest data source for commercial real estate. So you're going to be able to get like all of these data points, and you can even draw polygons around a neighborhood. It can get really crazy, and you can get all the data you want, cap rates, etc. Obviously, that's expensive. We're talking, $1,500 a month for that data service. Then you go a step down, and you could get a lot of this data from things like PropStream, where you can get that neighborhood demographic data that's very key to understanding the neighborhood. Your median household income, job, schools. And then a step down from that maybe is Neighborhood Scout. I still like Neighborhood Scout because that's relatively cheap. I think that's less than $100 a month now. And all of that data as far as median household income, schools, job growth, things like that are essential for picking out your market.
I love it. Good. So now that we've selected a market, how do you find the deals? Like, is it better to build relationships with other brokers? Is it better to go direct to seller? What's the best way to find deals for apartment complexes?
I think direct to seller is where you're going to be able to get the best deals. Now, you could do it that way. That requires more skill to go to direct to seller. You're going to need to learn how to pull properties, find the owner's information, learn how to market to them, and try and negotiate that. That's a little tougher. The easier way is to go to the brokers because they're essentially the gatekeepers of properties that are being listed for sale. So if you're listening to this podcast, how you would do that is call, major brokerage firms. You've got, Cushman and Wakefield as an example. These big companies have offices in all these cities, and you can call them, start talking to brokers about, pick up the phone and talk to them about what your criteria is. Like, I'm looking for properties that cost less than $3 million, maybe this unit count range, et cetera. And they'll send you an email or call you whenever they have the projects that meet your criteria. Now, If you're a newbie investor, it's unlikely that the best deals are going to get sent to you, because typically these brokers are going to be sending them to the people they know they can close, that they've already had a relationship with. And, like he alluded to just a couple minutes ago about building relationships with brokers, that's what he means. The brokers that we've worked with, that we've bought and sold properties with, we're on a first name basis with, they're typically going to call us like, hey, I'm putting together a package for a deal that's 10 units in this neighborhood. It matches up perfect with your criteria. I haven't marketed it yet. Are you interested? Those are the kind of calls you want to get. Now, in addition to that, if you're already going to be buying one of those data websites we just talked about, like CoStar or PropStream or something, those platforms, you can learn how to market to direct to sellers. Find sellers that have owned their property for 10, 20 years and own it free and clear or close to it. Those are always great people to reach out to. You could also drive for dollars, find an apartment complex that looks run down, hasn't had a lot of TLC, because typically those owners just seem to care less. Maybe they're mom and pop owners that are sick and tired of having to deal with all the maintenance and tenants. Those are great people to market to directly.
I love it. That's awesome. Now, once you, or what tools, like if you're going to market direct to owner, I know you talked about CoStar. Is that where you would get the phone numbers for the people that own apartment complexes, or what other tools would you need?
So in general, yes. Generally speaking, like it's hit or miss with CoStar, because sometimes CoStar, like you can go to like the loan information or the owner will be directly on there when you search for that property's address. Sometimes it won't be. Sometimes you might find an LLC, and then you can look up that LLC information and keep digging to try and find who that owner is. But yes, in a lot of instances, I've been able to get the owner's direct information or their email, or I've been able to get their address so that I can then write them a letter. So I think that that's always a great place to look. CoStar, I think, is king when it comes to getting that information. PropStream, you can still get that oftentimes, especially with the smaller multifamily. But when it comes to marketing them, I mean, really at the end of the day, it's either picking up the phone or writing them a handwritten letter. I would never recommend doing like the mass marketing where you're paying for them to get a printed letter that they probably won't open. You're always going to get a higher open rate if you write them handwritten letters. And I've actually done that and gotten owners to call me. So, those methods, just remember, if you're thinking about doing something like that, you're going to have a really low conversion rate. So you got to accept that. I mean, you might send 20 or 30 letters and have one person call you. That's just part of the game. But if that person calls you, you've got a pretty decent lead.
I love it. I love it. Now, all right. What is somebody looking to buy their first apartment complex? What should they be looking for in an apartment complex? Like, is there like a sweet spot in terms of units that makes it too low of a number or too high of a number? Also, are you looking for properties that are value add? What are we looking for? Are you looking for the ugliest property in the neighborhood? What's the key?
I think so that's a great question. Number one, you want to look for a property that could use some renovations to the interiors. I would say like light renovations, meaning like I would shy away from something that was built in like the 50s and 60s that basically needs an entire gut job. I've done it and I did well, but it can be a nightmare. And you can run into a situation where you're running out of money quick if you don't have experience doing that. So when I say light renovation, I mean a property that's where the owner has kept up with the maintenance to a reasonable extent, and you can just go in there, put in new flooring, freshen up the kitchens, maybe with granite countertops or painting the cabinets, things like that can get you an extra couple $100 in rent potentially. When it comes to unit count, if you're just getting started, I would shy away from anything above 50 units unless you have a lot of resources or partners that have done this before. You're typically going to have a lot more competition in those bigger units with groups that have way more experience than you. So like if you're in that 30, 32 unit range that I bought my first one in, you're going to be dealing with smaller, either private mom and pop owners or smaller groups that don't have, 10 times more experience than you. So it's going to be a little bit easier to buy it. But my biggest suggestion is to find value add opportunities where you can clearly identify other properties in that market that have the level of renovation that you're aiming for. So like I just mentioned, if you're going to go in and paint the cabinets, maybe put in some new appliances, new LVP flooring, etc., you can find properties that meet that criteria and empirically identify that they are achieving, for example, $100 more in rent or whatever the target is, to give you a good idea of the rents that you can achieve if you do these renovations. So, that's an easy step to do. You could do this without spending a lot of money, but identify a property where you can do some light renovations, get a good pop on the rent, to be able to make some substantial profit by increasing the net operating income. So I think that that's like a really general basic explanation of what you should identify. And I would just recommend and really press here that if you are looking for these value add opportunities and you find some properties that are an older vintage, that are 30, 40 years old or older, you really got to make sure that you do a very thorough inspection, because I've been burned before where I bought a property that was built in the early 60s and most of the cast iron piping need to be replaced. I had old clay piping that collapsed. The list just goes on. So just know that the older, cheaper properties are going to have a lot of issues.
Yeah. So basically, it's going to be a lot more work as well too. Is there a certain occupancy that you won't go below, like whenever you're purchasing a property? Like meaning, like I see buildings on LoopNet sometimes they're like, oh yeah, completely vacant, but it's because it's in really bad condition. And I know people that are like, oh, I only buy things that are 80% occupant or above. What are your thoughts on that?
So I'm in the boat of only buying properties that are 80 something percent or above. If you try and go buy, like there are people that do okay with buying properties that have really low occupancy that are not stabilized. When you do something like that, it's a completely kind of different business plan. You've got to be very well capitalized. In other words, you just got to come in with a lot more money, because you're basically not going to be producing enough income to meet your debts. And you're always going to have a challenge if you get a property with low occupancy with getting debt, because most of these lenders want to see 90% occupancy or greater for 90 days or more. It's the 90-90 rule. So especially in today's day and age with lenders tightening up their standards, if you are new to the industry and you try and go purchase a property that has low occupancy, you are going to be fighting an uphill battle with trying to get good debt. So I would say, for especially early on in your career, shoot for, in the 80s or above. Now, you can kind of skirt around that 90-90 rule a little bit if it's a little bit below 90% occupancy, because then you can demonstrate to a lender, like, we estimate that it'll take, 1 month to get this above 90% occupancy, because these units are downed units. All we got to do is go fix this stuff, and then we can put them online. So, like, you could work around that. But if you're at 50% occupancy, it's a lot tougher.
I love it. I love it. Now, who are what team players do you need whenever you're taking down these 32 units? Is it like a one-man sport team where you can be the person acquiring them, you're the person raising the capital, you're the person managing the property, you're the person managing the renovations? Or how do you build a team if you want to consistently do this, and who are the key players for that team? And can somebody do it individually if they wanted to as well too?
That's a good question. I think, you could obviously do it individually. I think especially like the smaller the project, like if you're doing a 10 unit, it's going to be a lot easier to do like a solo project. Totally doable. There's a couple of key team members that you need, like an asset manager, whether that's you or somebody else, is key. And what the asset manager does is they're managing, for one, if you're going to have a property manager, they're managing the property manager. They're managing the property manager in the sense of keeping tabs on, okay, we've got 3 units vacant. How many applications have we received? How many showings have we had this week, or do we have scheduled? If a property is still vacant 4 weeks later, they're on top of the property manager. Okay, what's going on here? With our asset manager, we're constantly like testing our property manager in the sense that, okay, pretend that you are an interested tenant in one of the vacant units and reach out on apartments.com or something. How long does it take your property manager to answer that inquiry? If it's taken them 2 business days, that's too long. You might have lost a potential lead. So things like that, the asset manager is constantly doing. looking at the account balance and how expense or how much money we're spending on, repair and maintenance, et cetera. There's a lot that goes around that, but essentially managing the property manager and the finances, the occupancy, et cetera, the entire operation is the asset manager right there. And that's incredibly important. And I want to really emphasize that, because even if you have a property manager, that doesn't mean that you just hand it off to them and walk away, because they're not going to really optimize it the way that you want it to be. The other key team member, I would say, is a project manager for like renovations. This is a little tricky if you're just getting started, and I would highly, highly recommend that you bring on somebody that has experience dealing with contractors or is even a contractor themselves. So for example, like nowadays on my team, I have a project manager that is an engineer and worked in commercial real estate project management for years and has done over $100 million in construction. And the reason why I brought that team member on is because my very first project that I've been telling you guys about, that was that 32 unit in Indiana. We needed to completely replace all the second story balconies because they were literally sagging and going to fall down. So we hired a construction company that has, works almost exclusively on commercial multifamily real estate. They built all these balconies before. They have a solid track record. We did all our due diligence. But when I just so happen to be lucky, and my father also owns a property or a construction company, has worked in construction. He went and walked these second story balconies when they were completing them with me. And we found that the level of craftsmanship was abysmal. I mean, like there were nails sticking out where they shouldn't be. The corners weren't flush, and, there was all of this shoddy work that they had done. And I would have had no idea and just completely trusted them if I didn't have someone with experience there with me. So we were able to get them to fix all of these errors that very likely would have just caused more issues in the future if we didn't know about them. So, that's just one example of many where having somebody with some kind of contractor or construction experience when you're taking on these value adds is just huge. Because otherwise you're not going to know if you're getting screwed. You're not going to know whether or not that work was done properly. So I highly recommend that team member as well. And then obviously, like you alluded to, raising capital and dealing with your investors, investor management is another huge piece. And that's the final piece I'll mention. There's all kinds of pieces you could have, but it's actually a lot of work to put together your reports. If you want to have a good investor experience, early on in the business plan, we like to do monthly reporting because there's so much going on. There's all these new renovations coming in and things are getting changed quickly. So we like to do monthly reporting early on in the business plan. And then as things like the renovations have been completed, et cetera, and there's much less to report, we move to quarterly reporting. But all of that, I say that just because that's a lot of work in and of itself. So I like to have a team member that specifically is focused on taking care of the investors and keeping them up to date and, on the business plan. So those are three, I think, really key team members, whether or not you're doing that yourself or bringing on people for.
I love it. So let's talk about like underwriting the properties and then financing the properties as well too. How do you go about underwriting properties? Like meaning, is it a spreadsheet? Is it just pen and paper? Any rules of thumb to see if something's going to pencil out?
Yeah, I'll try to give a couple of points right here. This is a common question I get. I do use robust spreadsheets. Now, I'm sure somebody's asking, okay, what's your spreadsheet? Can I get it? Sure thing. I buy got my spreadsheet as well as my mentor, who's again owns 8,000 apartment units, has been doing it for over 20 years. There's a company called Top Shelf Models. I think they have outstanding spreadsheets for multifamily, even development. And what's cool is like they also have like a university thing where you can kind of learn how to underwrite. Now, granted, I do recommend that you also like learn from somebody else with experience and et cetera, excuse me. But they can teach you how to use their model. They have a course that you could pay for a couple $100 to learn how to underwrite. And then if you buy a model from them and you want to have them kind of uniquely tailor it to a unique strategy you might have, for example, let's say you're adding units or something, they can do that for you. So I recommend top shelf models. I love their models. I'm not getting paid to tell you that. Another model that I think is pretty dang good is Michael Blanc's syndicated deal analyzer. You can just go to michaelblanc.com. He's a famous, apartment investor. You could buy his for a couple $100 as well. So those are the models I use. Really easy to learn how to use and get reps in. But when it comes to best practices for underwriting, I want to mention a couple things. One, what my mentor taught me, and is to, like, when you're projecting your exit cap rate, this is huge, because if you get this wrong and you're too rosy in your projections, you could find yourself screwed. So in my opinion, it's the most important piece of the underwriting. I recommend that you increase your cap rate. So go take your purchase cap rate or the current market cap rate and add 0.20 for each year that you're going to hold the property. So if you're going to hold it for 5 years, you're increasing it by 1%. If you bought at a 4 cap, you're projecting you're going to sell at a 5 cap. That's a really good conservative assumption that I know a lot of the big operators use. Now, it's okay to go below that, but just understand that you're just increasing the risk a little bit. So the more you change it, obviously you can make it 0.25 per year, and then that's even less risk. But the lower that you anticipate that exit cap, the more risk you're taking on. Another recommendation that I would use is to leverage your relationship with brokers, because each market can be different in the sense that, typical like maintenance cost or typical cost for X, Y, and Z, you can oftentimes get that from brokers. If you aren't sure, just ask them. Another like small recommendation I would do is always be really conservative with your rental assumptions. So if you're looking at projects, or excuse me, at comparable properties and what their rents are, make a chart of all of the comps that you've pulled and what their amenities are. And then you can enter in how much rent they're all achieving, how much square footage all of those rental comps are, and then get your rent per square foot. And then take an average number or the median and then apply that to the square footage of your rental units to determine what you think you can get in rent for those units after renovations. So, those are just a couple recommendations. Obviously, underwriting is insane, and there's all kinds of things you'll have to put in there. Like if you're estimating rent projections, typically people use 2% per year in annual rent growth. Even if your market is 5% per year, I would recommend being conservative. So, that's just a couple off the top of my head, I guess.
I love it. I love it. What about for financing the properties? What's the best way to secure financing? Is it local community banks? Is it the big boys, the Fannie Mae, Freddie Mac? What's the key there?
So the big boys, the Fannie Mae, Freddie Mac, are always going to be your the best place to get debt. Now, if you're just getting started, you're not going to be able to get Fannie Freddie debt unless you have somebody on your team that's gotten it before, essentially. And the reason why borrowing directly from Fannie and Freddie is the best is because you're usually going to get non-recourse debt in the best terms. Now, the place I love to go, though, is always commercial real estate mortgage brokers. And the reason why is because they can shop your deal to 100 different lenders, including community banks and big banks, et cetera. So I like to go with them. I'm able to give them all of the financials of the property, my schedule of real estate, all of the things that they want to see. That way I'm not filling out a package for individual lenders. You could do that. You can go walk into a community bank or contact them and start getting quotes. But if you go to a commercial mortgage broker, they can shop this for you. And so they make a little bit of money by doing that, but at the end of the day, it's going to save you a ton of time and get you in front of lenders you otherwise wouldn't get in front of.
I love it. I love it. And then I think that's it in that department. Good. What about the resale of an apartment complex? Like, whenever you're doing value adds, are you typically looking just to hold long term? Is it better to flip them? What's the best way to kind of look at that?
I think you're always going to make the most money if you hold long term. If you hold a property for 10 years, you're going to make the most money because like you've done your value add, and then after that, like rents just keep increasing while you have the same debt, and your cash flow will be more exponential. But it depends on, for me, we haven't had any deals go much further beyond 3 years. And that's just because our investor appetite. So our investors, like if I pitch a 10-year project to them, I'm going to lose a good chunk of them because so many of my investors invest the minimum $50,000 investment. And for many of those people, that's a huge chunk of their savings, and they would rather get that return a little bit sooner so that they can maybe hold some back and then redeploy the initial 50,000 or whatever the case may be. But they typically want to see that money flipped a little bit sooner. The wealthier investors and family offices and people that can write big checks, they always seem to want longer investment timelines.
Mm-hmm.
So I think it depends on who you're raising money from. If you're raising money from friends and family, I can almost guarantee they're going to want a 3 to 5 year timeline. So that's typically what our timelines are. For my personal properties, I want to hold them for forever. I just want to keep refinancing them and using them like an ATM.
Mm-hmm.
So one of the ways you can find this out, though, if you already have an investor database, we literally do polls and surveys with our investors. So we've sent them multiple surveys over the years, asking them, questions like, select which investment timeline, you're most interested in. And we might put, 3 to 5 years as an option, and then explain to them like, these options are going to be quicker returns on investment. But the longer investments might have a higher return. It's just a longer timeline. So we'll break that down for them. And sometimes we've been surprised by the answers. So I would say gauge your investors and see what they want.
Got it. And then for somebody that maybe doesn't have those relationships yet with other investors, or is kind of like looking to buy their first apartment complexes, where do you find these people? Like, where do you find people that are willing to invest in your project, especially as a newbie?
That's an outstanding question. And the best answer I could give you guys is to cast a wide net. Do everything you freaking can because, and here's what I mean by that, and then I'll explain why. So start your own podcast if you can. It's essentially a free way to start getting your name out there. Be a guest on as many podcasts as you can. Try to get on 100 different podcasts. I know that sounds insane, but whether they're real estate podcasts or entrepreneur podcasts, and just imagine if each of those podcasts, 1,000 people heard you. If you get on 100 or 100, then 100,000 people have heard you. So that's one way to get in front of as many people as you can. Start writing a blog. I say that because like my website, investorshawn.com. If you Google my name, you'll see investorshawn.com, my company website, and my LinkedIn. You want people, if they're to be able to Google you and find more information about you. So I recommend having a personal website where you can blog about your journey. The more you blog, the more that your personal website will rank higher. People can click on that website to learn more about you as a person, see your face, all that kind of stuff. I think that goes a long way. Host your own real estate meetup in your market. Go to other real estate meetups and try to present at those meetups if you can. Go to conferences. The list goes on. Write an ebook or an actual book. But if you look at a lot of the really successful apartment investors, pick a list of 5 of them that you like, do exactly what they did, because all of that stuff plays into it. I mean, I've gotten some investors that I met at real estate meetups. I've gotten some that downloaded my free ebook and then signed up to be an investor. I've gotten some from being a guest on other people's podcasts. You get some from everywhere. So you need to be doing as much as you can to make sure these people can find you. I also make content on Instagram and the list goes on. But I think that a lot of these things are very cheap to do and you just have no reason not to do them because the risk adjusted returns are amazing.
I love it. What are some of the challenges or some of the things that maybe when you got started that you didn't really factor in, or what's been some of the challenges that you've had to overcome over the years that maybe you didn't expect, or kind of like, oh man, I didn't realize this? Because to a lot of people, like obviously investing in apartment complexes sounds really good, but it also comes with its challenges. Like I know when I bought my first apartment complex, my biggest unit was a 7 unit before that, and like a bunch of like 2 or 3 units. And to go from a 2 to 3 to a 25 unit, it was just a lot more management intensive, especially because it needed a lot of renovation. So, what
Mhm.
was some of the challenges that you have faced, and how have you overcome them? And what advice for newer people looking to buy their first apartment complex would you give?
The two that just come to my mind immediately, number one, are how hard it is to find good deals that I want to do. It's, depends on which guru you ask or see on a podcast or something, but some people are like, oh, there's plenty of deals out there. And my personal experience, for me to feel comfortable doing a deal, I have to look at like 100, and of those 100, maybe 10 make sense, and of those 10, I might be able to close on one or two. Um, you're just expect when you're getting started, you're going to underwrite so many deals that you're going to get sick of it. You're going to start thinking to yourself, man, wish I could pay somebody to just underwrite deals for me. That's how I felt, because like I said, if you're looking at 100, if it's a one-man show, you're underwriting 100 deals, and that takes forever.
Hmm.
So I would say finding deals that like are in neighborhoods you want to invest in, that you have a high degree of confidence that you're going to be able to succeed on the business plan and not lose anyone's money and actually get a good return. That's hard to do. So just accept that. And the way you overcome that is by doing more deals to grow your company so you can afford to pay somebody to do that for you full time. The other like big challenge is starting to build that investor database. Because if you're going to do this as a business like me, you need to raise money every year. You need to raise millions of dollars essentially. And that is more easily said than done. So like I mentioned earlier, I would recommend doing as much as you can as early as you can, because that stuff takes time to build. People are invest with those they know, like, and trust. Well, people got to get to know you, and then they got to get to trust you, and that takes time. So I would say start early and just stay consistent, because it might take you a couple years. It might take you a couple projects being successful before people really start lining up at the door to do a deal with you. Those are some of the two biggest challenges that I faced, especially over the past like 2-3 years, when like multifamily was really on fire and everyone was trying to do it. It became so hard to find deals that penciled according to the conservative underwriting that my mentor taught me. So I would just say, expect to have those same two challenges, unless you came from a different background where you just got boatloads of people with millions of dollars ready to invest with you. But I didn't have that. So you're going to have those same challenges. Just that's part of the journey.
I love it. I love it. Good. Sean, any final words or any final tips for our viewers that you think would be helpful?
No, I don't really have any final tips other than I just become a student of multifamily investing. If this is what you want to do, you need to spend thousands of hours studying, networking, practicing, getting reps in with your underwriting, walking properties, looking at listings that are for sale and going through those financials. The more you do that, the more you're going to become an expert at it. It's going to take time. Just commit to studying and learning this business. And trust me, over time, you're going to become an expert that people are seeking advice from. It's going to take years to get to that level. So I would just say, enjoy the journey and embrace it.
Got it. And then if somebody wanted to like maybe connect with you, maybe somebody enjoyed this topic, wanted to maybe learn from you, what's the best way for people to get in contact with you?
I'm going to give two ways. The number one way is to follow me on Instagram, because I put out daily content and put a lot of work into it. And so you'll be able to keep track of me, what I'm doing, get advice, all that kind of stuff. You can find me Shawn_Dimartile. So, look at this episode description and you'll see how to spell my name. And then you could also find me on investorshawn.com, spelled SHAWN, investorshawn.com. You can get links to everything that I put out there, download my ebook, all that kind of stuff, and learn more about me.
Sounds good, man. Well, Sean, I want to say thank you for coming on the show. I want to say thank you for sharing everything that you know. For our viewers out there, we had Shawn Dimartile. We talked about how to buy your first apartment complex, a step-by-step guide. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful, make sure to hit that share button. To our viewers, once again, thank you so much. And Sean, thank you again for being on the show. Until next time.